All right. So what are some of these bullish? So what are confirmations? What are bullish signals? When the stock breaks out, what do we want to see, right? So the first thing is we want to see follow through buying. It doesn't always happen. You may not get follow through buying, but we'd like to see follow through buying, especially if you're coming off of a big correction or a bear market. And these are some of the first stocks to go. They usually go, and you're going to see days of rally. Dave, why do we want to see multiple days of follow through? We want to see a stock break out and then follow through and have several days moving up.
Well, it's a sign of institutional buying, and the bigger the volume, the longer the number of days goes of where the stock is up and it's up on big volume, is just more signs of institutional buying, and that's what powers a stock higher. These moves where a stock doubles, triples, quadruples, it's not done just by retail buying, but it's the huge money that is behind the institutions that create these huge moves.
Yeah. Now, and there's a few ways that we can look for these footprints in the snow, if you will, or tracks in the snow, to see if we're looking at institutional volume or if it's retail volume coming in. So one is follow through buying, see multiple days. Another one is to look at the days. Once you get 3, 4, 5 days, 7, 8 days under your belt, how many days are up versus how many days are down? How many of those days have good closes versus how many have bad closes? How many have volume on the upside versus volume on the downside? And you're going to look for, of course, that tennis ball action, that natural reaction. Is it coming back and it was spending more time pulling back and less time rallying? So let me show you how that looks. So here's Yelp. So you come out of the buy point here, few days, you come in here, that's completely natural. And then wham, look at these days, 1, 2, 3 days up, and look at the volume coming in. So that's definitely big volume coming in. You're talking about over 8 million shares here. It starts off with about 3 million shares, moves up to 5 change million, up to 8 or 9 million shares. So the volume's getting heavier, and then you have just a brief pullback and right tennis ball action right into new highs again. That's a very successful breakout. That's exactly what we want to see. And Dave, you said something. I remember when I read it many years ago, decades ago, of course, in Market Wizards, you said the best, and this has resonated with me ever since, the best thing a stock can do is be at a profit right away. And that's how I know that I'm probably going to make money on the trade. What did you mean by that?
Yeah, well, now you get you get a confirmation of your purchase within seconds. But it was usually in the old days, you would call a broker or call the trading room, and by the time they gave you your price of execution, you were already up on the stock. And it's almost the stocks that are hard to buy, where you try to get your position bought, your starting position, and it's actually moving so quickly it's almost hard to put on add-on buys. So it's those stocks that are up immediately on the day, within even the minutes that you buy it, are the ones that are probably going to be your biggest winners.
And did you find historically, looking back at your track record and your past, and just from anecdotal evidence, that's usually the case, that those are going to be the winners, and the stocks that don't have any real power on the breakout and come back in, those if we were to bet on those two groups, the group that has the confirmations is going to probably do much better, right?
Right, because I feel that I've gotten my timing down, and I know exactly what to look for, that I'm expecting at the moment I buy that stock should be turning higher.
Okay, and that's where David just gave you the key. That was the golden nugget. See, it's about getting the timing down. This is how you know if you got your timing right. This is all about timing. People always ask me, do you time the market? I don't really time the market. I time stocks. Timing the market is very difficult. It can be done, but it is very difficult. It's very random, and the market itself as a whole is somewhat efficient. Stocks are not. Stocks are very inefficient, and you can time them quite beautifully. So that's what it's about, and it's about knowing whether that train is coming in on schedule. If you've timed it properly and you're waiting for the train to come in, and then to be proven that you're your timeline is correct. Now, again, here's another thing. Here's another little subtlety. So we're going to get into real subtleties now, right? These are things that you probably would never be looking for until you start to learn them, and then you'll see them. I mean, you'll immediately look at a chart and you'll know, yes, that looks good. Nope, that's not acting right. So if we look at the days here and we look over this 9-day rally, 7 of the 9 days are up, right? So only 2 days down out of that time. And then look at here, 1, 2, 3, 4. We've got, I'd say 5 or 6 days are good closes in the upper half of the range. So more good closes than bad closes. So everything is really hitting on all the cylinders here. Let me show you another example. So, okay, so here you see, again, you break out 1, 2, 3, 4, 5 days. 4 out of those 5 days are up. Just this one day, 1, 2, 3, 4 good closes. So you got 4 good closes, 4 days out of 5 days up. That's excellent. That's great. So now we're out of the gate. We broke out. You might be tempted to take this profit. It's up, I don't know, $16, $17 up to $22. You have a nice little move there, right? Maybe you're up 15-20%. So now the big $64,000 question is, do I sell? Do I hold? Well, again, you should probably go through that first pullback and see if you can get tennis ball action because you had such a successful breakout. Now you get the tennis ball action, and now that means you should try to hold it and go through another pullback, or at least go for a bigger gain on it. So now again, you go through another pullback, more tennis ball action, and again, you just keep going through this process, engaging it. Now, here's the key, and this stock from this buy point went up almost 500% in 11 months. That's a huge move in a very short period of time. And that's the key about the timing, is when you get that timing right, you can get very big moves in very short periods of time. And that's the key. That's how I've compounded all these big returns. And that's how David won U.S. investing championships. And that's the way that you get the big returns, is to be able to compound, because time is money. We talked about that earlier. Now, okay, another thing I want to point out. We're on page 222, by the way, right now. Another thing is that to play these for a bigger move, again, you're going to have to go through some of this more volatile periods. But again, if you're short-term trading, you're swing trading, or even you're shorter-term trading, you may be selling into this first move, or you may be selling into the second move, and that's going to be your window. If you're playing for a larger move, well, then of course your risk reward ratios are going to be you're going to be different. You're going to have a larger average gain probably, and then you might change your parameters a bit. But this is still, no matter if you're going for a swing trade or if you're going for a bigger move, we're talking about what to look for from the breakout. Okay, once the stock comes out of here, and then it gets. And I don't know if you talked about this. I can't remember, Dave, if you talked about once the launching pad, the rocket comes off the launching pad. Once it's out, now we don't have to look for that volume coming in and that 1-2 punch that I talked about and all that. We're just looking at the pullbacks and the natural reaction, and whether we're getting the tennis ball action. And we're not looking at we're not having to have big volume on breakouts. It can still go up. It can even go up on lighter volume. All right. Why don't you just explain that?
Yeah, the most important volume you want to see is when the stock is coming out of a base. And as I said earlier, the bigger the volume, the better. But once the stock is out and running, you don't have to keep on that huge volume doesn't have to keep on coming. Yes, you want to still look at the volume, and you want to look for big volume spikes, especially if the stock has been moving for a long time, and then you get a huge volume spike to the downside where the stock is down and the volume is very, very big. That you want to take notice of it. But stocks can go for a long time on some very, very light volume, and the example I use, it's like a rocket coming off the launching pad. It blasts off, and it needs a tremendous amount of fuel to get it going. But once it starts up and it's been going for a number of minutes, then it doesn't need as much fuel to keep it going, or as much volume to keep it going. And then once it gets into orbit, then it takes a very little amount once it gets into its orbit, and it can go for a long time. And it's just sort of the same analogy that you can use with a stock taking off and a stock in a nice uptrend.
Here's a stock that I bought, Baby Stores, back in '98. Came out of a perfect base, nice tight pivot. You see nice big volume here. See these 4 days? 3 out of 4 days up, right? Now, look at the volume. 1, 2 on the breakout, on the 2 breakout days. Then the pullback, look how low. And then again, boom, big volume here. So now we come off of that launching pad that David's talking about. Now we're up in the sky now, right? Okay, great. Now we're looking to see if the pullbacks can come back in and then get tennis ball action if they're natural reactions. Natural means it pulls back, maybe pulls back 4 or 5 days. Sometimes they pull back just a couple days, maybe 4 or 5, 6 days, and then just a couple days back into new high ground. Right here, you had a 1-day pullback, and then it came and it went moderately into new high ground. And then again, right here, back into new high ground. Another pullback, 6 days back, and now we form this little, see this little tiny little VCP. It's the exact same thing, almost looks like this pattern, only on a little mini basis, and we come out again. You get another natural reaction until finally, you're looking to start nailing down your profit into a decent move here. So we got one, we can call this 2, maybe 3, 3 or 4 natural reactions. Now, I'd be looking to probably sell if the stock really starts to run up here. We're going to get into sell rules, so I don't want to talk too much about selling just yet, but we're going to get into sell rules, and we'll show you that too. But right now, we're just talking about looking: is it natural? Is it a breakout that is confirming, or are we seeing violations? And we're going to get those violations in a minute. Let's keep looking at confirmed breakouts that are looking good and acting well, and then looking to see what we need to know if we're going to hold them for a bigger move. Look at this, 8 out of 10 days up. So this breaks out, goes up 8 out of 10 days, just a really strong breakout. You want to go through a natural reaction here and then see if you can make a bigger move, because the stock is just acting so well. It's such a great breakout. This is such an indication that institutions are piling in, and then with a very small pullback and a quick recovery, it's just total confirmation. So again, another natural reaction, boom, 1 day back into new high ground. A few more examples. Zillow. So Zillow comes off of this pivot. It's a little cheat area. Look at this, 7 out of 8 days up. Look at this natural reaction. It barely pulls back at all. That's how strong the stock was. And then bang, right into new high ground. Then you get another little pullback. 1, 2, 3 days. 4th day turns up. Just 1 day later, back into new high ground. And look how strong, right? Another little natural reaction, back into new high ground, little mini cheat area formed here. So it just keep going through this. Now, again, once I get to that, like I said, you get to, a couple natural reactions, 3 or 4. Now I'm going to start looking for more volatility. I'm going to try just usually sell into the upside and try to get out before I get that volatility comes in. Okay, REX, another little cheat area right here, comes out 5 out of 6 days up. And you see how you drift in here, and then in 1 day, boom, back into new high ground. You had a squat on the close, but 2 days later, you recovered that too. Now you get a little more volatility, same thing. All right, let's take a look here I want to talk about, Dave. So when we get these breakouts, this is what you call your MVP indicator, or an indication that the stock is really, really strong. You talked about this, I think, in Momentum Masters, and we always get a lot of interest in this concept. Google's a perfect example. Why don't you talk about this? When a stock breaks out, you found that when it was, and maybe you can go back and talk about the history of this.
Yeah, this is something that I kind of spotted when I was running the New USA Mutual Fund, which was during the mid 1990s. I was
with O'Neill, right? That was with O'Neill?
Yeah, that's when, O'Neill wanted to start a mutual fund to help support the newspaper. And what happened, what I started looking at is that we would buy a stock as it was coming through its buy point, but then when it got extended, then we would stop buying. But what I noticed is that some of these stocks just kept on going higher, and they did it on volume. And these turned out to be some of the biggest winners. But we stopped right at that, at that time, it was like we would stop buying at 10% from the pivot point. Now, now it's a lot closer where you were saying 5% or less. But the closer you can get to the buy point, the better. But anyway, we found in these big winners is that they had some very common factors. And from the time they started moving, their first up day, they were up 12 out of 15 days. And they were also up 20% or more in price. And during that 12 out of 15 days, they had at least a 25% increase in volume over a typical 15-day period. So above average daily volume, they had a big increase. So those were the characteristics found in stocks that just kind of kept on going versus stocks that made a 20% move and then pulled back. And these things kept on going higher. Yes, eventually they build bases, but they turned into be some of the stocks that moved for a year and a half or more.
And this, Dave, this turned out to be what is known now as the ants. Ants.
Well, yeah, the reason why we called it ants is because the programmer actually put little markings on the chart, little black dots where this started happening. And so they look like...
I should have done that. I should have, out of all these years we talk about this, I should actually put those on and illustrate that. Maybe at another time we will do that. But yeah, so they called it the ants because you'd put all these there's these little hash marks that would show where the stock met that criteria, right?
Yeah, and this looks like it met it somewhere around where that first tennis ball action came in, right around in there. That would be 12 out of 15 days up from just the buy point would probably be about where it started. It would, if we had a color chart, you'd actually probably see it a little bit better. But it's just you want 12 out of 15 days. You want big volume, and you want the stock to be moving up 25% or more during that same period of time.
Let's be clear here, Dave. Sorry to interrupt, but let's be clear that we're not saying that once you get 12 out of 15 days up and it's on volume, that you're necessarily going to be buying there. The stock may be extended at that point and may be due for a pullback. But let's just say you bought it here at the breakout. And now we're up 7 days in a row. And then it meets this criteria where 12 out of 15 days it's up and there's a good increase in volume. Well, that's a stock that you may not want to sell. And you might want to hold for a much bigger move. Or if it can pull back and maybe rebase, take that stock very seriously on that next move up, or maybe you sell out of it and you take that short-term profit, but you're looking to buy it back on a pullback buy. So this is just an indication that the stock is really strong and that you may have a tiger by the tail. Would that be right,
yes,
Dave?
Yes. And you don't, in something like that, you really don't want to lose the position, because these are the ones that, again, as I said, you're looking the other way. You've got other stocks, and all of a sudden this thing just breaks out again, and you miss it, and then it takes off for even a bigger move. And it's just, you want to keep something in there, so you keep a close eye on it, or you just don't sell much of it when you get that indication that you've had powerful buying. Yeah.
This was Google. That was the case. This was Google. Now, this also, this tennis ball action and counting the weeks up and so forth, and up days versus down days, good closes. This works on a weekly as well. This is all. It knows no time frame. So this is just a weekly chart of National Beverage, and you can see again breakout, natural reaction, tennis ball action, runs up, natural reaction, tennis ball action, same exact thing. It's not going to change. None of this is going to change. People, worry whether this is going to change, or if everybody takes Mark Minervini's seminar and listens to Mark and Dave, it's not going to work anymore. This the law of supply and demand. This is like gravity. It's not going to change. It's the same, and I assure you too, most people aren't disciplined enough to even stick to these rules and these strategies to begin with. So again, take a look at here. It's on a weekly. So you see the breakout on Netflix came out of here, and we looked at the daily. Remember, we saw those nice little bursts, and then the pullbacks, the natural reactions, and then tennis ball action. Well, we look at a weekly, 6 out of 7 weeks up, and then we pull back here, and then look how quickly it takes all these weeks to come back to the breakout point, and then look at the tennis ball action. Pow! 1 week, it erases all that. You see, that says, and I remember this was, I believe this was on earnings. I remember when the stock did this, and then it just drifted up, and I think this also might have met the MVP or ANT's criteria.
Yeah.
So now, here's the question: what do everything we just looked at? What do all these previous examples have in common? And this is what you want to look for that optimal stock, that stock that breaks out, and the stock that you want to hang on to and go for that big winner. Number one, they're profitable immediately. Remember Dave said, the stocks that are up and he's at a profit immediately, those are the ones that generally turn out to be the bigger winners. Follow through buying. They all showed follow through buying. Right after the breakout, there was follow through buying. There was multiple days. More up days than down days, and more up weeks than down weeks, whether you're looking at a daily or a weekly chart. More good closes than bad closes. Closes in the upper half of the range versus the lower half of the range. Tennis ball action. They all had tennis ball action, right? They all came coming right back, and good volume characteristics where there was high volume on the rallies and low volume on the pullbacks.